How's everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to have a quick discussion about a bank's insurance bond and basically how it relates to fraud. So, all types of bank fraud are on the perpetual rise in banking, and banks have an insurance bond, which they basically use to cover fraud losses. Just to give everybody an idea, like fraud losses, you think of customers that suffer identity theft, but you also have wire fraud, you have check fraud, um, you have what else? What else do we got out there? I'm thinking some of the major you have debit card fraud, um, payments fraud. Obviously, like Bank of America, JP Morgan recently experienced a lot of fraud through Zelle, the Zelle network. They're having a lot of issues with. So there's a lot of fraud out there, a lot of different types of fraud out there that are affecting banks every day. And that level of fraud is going up. So the question is, if a bank sustains too much fraud, can they, basically not have enough in their insurance bond to cover the fraud losses, and thus then those losses have to start coming out of pocket. So I saw this article in Bank Director, and it's basically called "Will Your Bank Be Covered When Fraudsters Strike?" So with fraud on the rise, directors should know the ins and outs of their bank's insurance bonds so their institutions can be reimbursed for losses. So as we get in here, one of the most overlooked elements in the industry's fight against fraud losses could be the bank's insurance bond. Fraud has mushroomed in recent years as bad actors have taken advantage of digital channels. Criminals have also targeted the mail to steal and alter checks, like I said, check fraud, despite a decline in check usage. According to the Treasury Department's Financial Crimes Enforcement Network, or FinCEN, depository institutions filed nearly 1.4 million suspicious activity reports, or SAR reports, related to fraud in 2022, nearly double the number filed in 2019. Reports of possible wire fraud rose 63%. Suspicious activity reports related to ACH fraud increased by 107%, and reports of check fraud increased 119% over that time frame. Against this rapidly changing threat landscape, proactive boards could review their bank's insurance policy to understand what it does and doesn't cover when it comes to fraud losses, and the actions the bank needs to take to ensure they're reimbursed. So losses can be especially painful for smaller institutions. In other words, banks say under 10 billion in asset size, particularly I would say under probably under $1 billion in assets. If a bank director really wants to have as close to zero as they can get on a reasonable basis for fraud losses, the best place to look is going to their insurance bond, says Sarah Beth Felix, founder and president of Palmera Consulting. An insurance bond doesn't prevent fraud, but it can cover much of the bank's losses when fraud does happen. Boards should regularly review that policy and understand its limitations, as well as any steps a bank may be required to take to be compensated. Questions about the bank's insurance coverage should be part of a broader conversation around risk management and oversight of fraud prevention efforts. It's far better to not suffer the loss, but you want to have reasonable ways to make yourself whole if you do. When reviewing the bank's insurance coverage, distinguish between aggregate coverage and single event coverage and ask about limits. That can make a big difference in how much a bank is able to recoup. For example, a bank might end up assuming that all the losses resulting from a counterfeit check scheme, if each check comes in around 3,000, and a bank's single event coverage kicks in once losses hit 5,000. So covering those losses could be a simple matter of phoning the bank's insurance agent and adjusting the monthly premium. It's easy, but most banks don't do that. And that's the best rock to look under. In some cases, an insurance policy may require the bank to hire an outside investigator. But it says basically banks seldom pursue litigation against employees who've committed fraud, fearing reputational blowback if the bank is perceived to be vulnerable. Specifically, he says insurers want to know that the fraud has taken place and that it's been investigated and that the bank tried to mitigate losses. So investigators often have to submit this documentation to the insurance company. For fraud tied to instant payment services like FedNow, policies often require that a bank take proactive measures. There are specific steps that a bank has to take in order for them to have a single claim covered by their bond, such as multi-factor authentication. So you know how, like, every website now is popping up with multi-factor authentication. Well, this is part of it. It's because of insurance. Or a callback procedure to verify that a customer has indeed authorized a payment, she says. An insurance bond might not cover losses incurred through FedNow if those requirements aren't met. So it's important for banks to talk with their insurance carriers if they're moving forward with real-time payments solution. So understanding that the bank's insurance bond will and what the insurance bond will and won't cover and the steps a bank must take to be reimbursed for losses are vital in a bank's effort to battle fraud losses. Effective fraud prevention often requires introducing friction points to slow down and deter bad actors. Additional steps that may create a worse experience for bank customers. Exactly. That's exactly where I was going with this. So all this stuff is great, and it certainly helps with your, insurance protection, but it is not going to make for a better customer experience. When customers have to go through yet another layer, when you're logging into your account, you got to put in your username, your password. Maybe you might have to put in some kind of number or some other identification type of thing to get into the account. And now you're going to layer in two-factor authentication. For a lot of companies, a lot of small businesses out there that send wires quite frequently, such as title companies and the like, calling in to verify can become a nuisance depending on how many wires you're sending. If it's one wire every couple months, then who cares? It's not that big a deal. But if you're sending multiple wires every day, then that could get to be a little annoying. So, but banks also have payment systems for sending out wires and trying to streamline things a little bit more and that kind of stuff. But this is, like I said, it's really interesting because, I think a lot of times people don't think about banks having like insurance policies, like oh well, banks, like in other words, they tend to not think of a bank like any other business or any other small business, and in reality they absolutely are. That is exactly what they are. Especially with your smaller banks, your bank's $1 billion, under $1 billion. They are, they operate like your typical small businesses. So they got to look at their insurance coverage. They got to look at, okay, what kind of losses are we getting from fraud? And then how do we make adjustments to those policies? So just some, like I said, just really interesting to note, some interesting things out there. I think people should be aware of how much fraud that banks face, because it is a huge challenge for banks of all sizes. Every bank has to deal with a tremendous amount of fraud. Oh, cyber fraud was the other fraud I was thinking about. People trying to hack in to your systems every day. People trying to hit you with malware, with ransomware. People trying to do what's called business email compromise, BEC, break into your system, take over, your email, and then try to send out wires. A couple episodes I did, or a couple, episodes I did a little bit back, had, I told a story about a couple of, kind of a very interesting wire fraud story that had to deal with business email compromise. So, it happens, and it happens almost every day. So it's a big thing for banks to deal with. So, like I said, just something interesting, something to make note that, on the bank's insurance front, kind of thing. So, but anyway, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. You can always check us out on YouTube, Rumble, and all major podcast platforms. Please check out some of the other episodes that I posted this weekend. And I hope everyone has a wonderful Memorial Day, and I will see you again real soon. Thanks.